The last one is the loan balance when this investment is terminated. Now, if you kept this irrigation system for 6 years, the loan would automatically go to zero. But if you sell it before your 6th year, there's still going to be an outstanding balance that you owe. Now, we can obtain this from the amortization schedule, or, as I promised, at some point in this class, I would bring back the concept of book value. Well, here I'm going to bring it back. You can also calculate the loan balance by calculating the book value of the loan. As it turns out, it's a useful tool. One of the more useful tools you'll find using your calculator is that for any loan, you can calculate its outstanding loan balance of a fully amortized loan by calculating the book value at that point in time. And if you understand that, that's very easy to do. And I'm going to show you how to do it. But you can use those 5 financial function keys on your calculator at any time to calculate it. You might say, well, so what? Why would I ever do that? Well, you've purchased your new truck on a 5-year loan, and you're deciding that you want to maybe sell it, in 3 years, and you want to say, well, how much will I still owe on that truck in 3 years? Well, you go dig out your amortization schedule that your lender may have given you, or you can pull out your calculator, and with 5 keystrokes, you have your answer. To look at the loan balance at the end of the 3rd year, it's quite simple to do because it's the loan balance at the end of the 3rd year is $42,824.90. Okay, there it is. You can also calculate that amount by using the book value. If you recall, the book value by definition is the present value of the remaining payments discounted at the contractual rate. So in this case, if at the end of 3 years, how many payments are left? 4, 5, and 6, right? So there's 3 payments left at this $17,221. What was the contract rate? It was given at 10%. Okay, the remaining payments, there was 6 years. We paid off 3, so there's 3 payments left. The contractual rate is 10%. We find the present value of that uniform annuity. The book value then is simply to take the payment and discount it back at 10% for 3 periods. We plug this into our calculator, 3N, 10% I, the $17,221. Okay, as payment, zero out the future value, compute the present value, which will lead us to the book value, and it comes out to $42,824.90, exactly what we had when we did it in the amortization, or when we found it through the amortization schedule. So that provides our last component, and we put it in period 3, $42,825, which gives the loan balance at the end of 3 years. Now let's just sum up each of those columns. Each column, we're just summing them up to give us the net cash flow after the debt. Now if we look at this, what does this chart tell us about the financial feasibility or liquidity of this irrigation system? We know it's profitable, right? We calculated the net present value and it was over $2,000, so we were getting our required rate of return. But what about the liquidity? First of all, you can see that the down payment is $5,000. So this farmer has to come up with $5,000 for that down payment, or even though it's a profitable investment, he can't buy it. What else do we know? Look in this first period. After taxes, this irrigation system in the first year generates $12,715 a year. Nice, right? Pretty good returns. But notice that we have to pay $17,221 to the bank. Well, that's offset a little bit because it's tax deductible. But that year in net, we have a deficit of $3,006. Even though this is a profitable investment, we have a $3,000 deficit. That means the farmer needs to generate at least $3,006 in the first year to cover that deficit. And if he can't cover that deficit, what happens? If the farmer can't generate some $3,000 from some other source to cover that deficit, to pay that debt, what happens? Repo. Okay, the lender gets upset. It's not just repossession, it may lead to foreclosure of the farm. And even if that doesn't happen, it's certainly going to take a big hickey on his credit, which the next time he goes to borrow money for anything, it becomes more difficult. And notice that in the second year, okay, there's only a deficit of $2,734. Why is that deficit going down? You have more net cash flow that we see in that process. So the reason that this is going down is because of what? It's because you have more cash flow coming from the investment. You have $2,734 that needs to be covered in the second year. In the third year, notice that you have a positive cash flow. Why is that? Because you're selling that irrigation system, so you're getting some cash flow from the sale of it. Now, if in this case you can't generate enough to cover those deficits, then you wouldn't take on this investment. Or if you don't have $5,000 in cash for the down payment, you wouldn't cover the investment. Now the next question is, how do you know whether you're going to have surpluses from the other parts of your business, from your accounting classes? If you're projecting out your cash flows, what do you use? Your projected cash flow statement can be then used to see if you're projecting enough surpluses from that business to cover those deficits. Just to review again how to calculate the remaining balance of a loan using the concept of book value. For example, if you purchased a new truck on a 5-year note, and after driving it for 2 years or 3 years, you're thinking about selling it, and you wanted to know how much you had to sell the truck for to pay off the note and maybe make a little extra money, at least pay off the note, and you ask yourself, well, how much will I owe on this truck in a month from now? You could pull out your financial calculator and calculate the book value of that loan, and you would have it. It's a slick concept, it's a slick tool that you can use. Right now, most of you don't own houses, but the same concept works for your house. You buy a house on a 30-year note, and you've owned it for 5 years, and you want to know how much you still have left remaining on the note. With 5 keystrokes of your financial calculator, you can get that number. So we're going to use the book value to calculate the remaining balance on the following loan at the end of 7 years. And we assume that we're going to borrow $5,000. The interest rate on that note is 6%. It's going to be fully amortized over 15 years. And we first have to determine what are the annual payments. Okay? And all these problems are sequential, so we have to know what to solve for first. In this case, we have to know what the payments are on that loan. This was a $5,000 loan, and the rate was 6% over 15 years, and we want it fully amortized, which means we need this uniform payment to the bank at the end of each of the next 15 years. And you can see that we know the present value. We know it's a uniform series, so we're going to use the present value of the uniform series annuity, and we're going to plug 15N, 6% I, 5,000 present value, zero out the future value, compute the payment, and it comes out to be $5,114.81. Now, what's the definition of book value? The book value, as you recall, is the present value of the remaining payments discounted at the contractual rate. What are the remaining payments? This was a 15-year note. We said we wanted it at the end of the 7th year, so we paid on it for 7 years. How many payments are left? We have 8 payments left on this note. And what's the contractual rate? It was given at 6%. So in this particular case, what formula do we use to calculate the book value? We know it's a uniform series. We're trying to calculate the present value, so we're going to use the present value of a uniform annuity. To calculate that, we put 8N, 6% I, the $514.81 as our payment, zero out the future value. In this case, we're going to calculate the present value, and it comes out to $3,196.89. You can see that that's very easy to do on your calculators, because what you did on your calculators, you said this is 15N, 15 years, 6% I, a $5,000 present value, zero out the future value, and you computed the payment, right? So just right then, to calculate the remaining balance at the end of the 7th year, what did you have to do on your calculator? There was 8 periods left, right? So all you had to do is put 8N and then compute your present value. I took you through all the steps and we had to go through all of it, but once you know how to do that, you could have done all of that in 7 keystrokes. Beats the heck out of doing the fully amortization table, doesn't it?